You had mentioned, you talked about bridge debt, interest rates right on the wall. I mean, it's going to be going up. To what degree, we don't know. But, and you talked about bridge. It may have been on your podcast where I heard that, I don't know if it was you or it could have been a different podcast, but the buyer was a little frustrated. He didn't get a deal, and he went back and was like, hey, what type of financing was, the person who got the deal? Like, what kind of financing were they using? And they were using bridge, which allowed them to get a much greater loan to value than what he was using with conventional. And of course allowed him to justify a higher price too. But what concerns do you have about the uncertain economic climate ahead? And how are you preparing to navigate it? What are you telling your coaching students on how they can prepare just to, everything's mitigating risk. So, well, what are you doing to mitigate that uncertainty?
Well, you need to look at the debt markets because debt is a circulatory engine of the economy. And when you're looking at debt tends to pull back. They tend to deal out debt less. And we just got quoted a deal for 54% loan to value. Agency wanted on this deal. How do you make a deal work like that? I mean, that's what they're doing. They're lending less money. They're taking less risk. So what ends up happening is one or two things. People come in with all that cash. They have less cash on cash day one, 18 months or whatever. And you can see how that affects expectations of investors. So our investors' expectations going to drop. They have been dropping. They will continue to drop. But at some point, prices need to adjust. The sellers right now have this unrealistic expectation of pricing. They've had it for the last 2 or 3 years. The brokers, they're just going to follow the sellers. They're going to try to get them the highest price, which is their job. At some point, when rates start to rise, whether cap rates rise or lower, you're just going to have to pay less for the property because debt's going to just be a huger component of it. So for me, I'm thinking, and I've been thinking for a while, the only thing that saved us over the last 18 months is the inflationary aspect of it, and with rents rising and what they've done with COVID. If COVID did not exist and they had not created this artificial bubble where you have so much demand, not enough supply in the economy, it's going to come to a point where, people aren't working. They're going to have to get back to work. And when they get back to work, are they going to have a job? That's the thing. This economy is built upon jobs and built about demand. We have had a lot of demand in a lot of weird sectors. When did you ever remember in your lifetime, we're in a recession and boat sales of second homes? All these things that you would think that people would cut out, self-storage, they're through the roof because there's demand for them, and people doing work on their homes is just so upside down and so inverted. So if anybody's out there telling you what they think is going to happen, they've been wrong for the last 2 years, where there was a forbearance tsunami, an eviction tsunami, renters not paying. No one wants to take culpability, and they don't want to because they don't know what's going to happen in the future. For me, it's always sticking to my criteria of buying these really good deals. And Dr. Linneman said in our podcast, Dr. Peter Linneman, if you're going to buy real estate, look at it in terms of decades. You're going to have 2 really good years, 2 crappy years, and 6 years so-so. That's why with the buy right criteria, this deal we're buying, it's a 05 build. I don't mind holding this for the next 10 years plus because it's not really going to age out. Now, if I'm buying this 21 unit that we're buying, it says 70s build. We're going to go in there. We're going to rehab everything and make everything as new. But we love the area as well. So we don't mind holding this, and we can see ourselves holding this for the next 10 years. Or else our exit strategy would be 3 years. Let's rehab it, finish it up, and flip it out, make a nice profit, move on. But we're vertically integrated. So we're looking for deals that we can hold long-term because we property manage them, we asset manage them, we control the entire process of it. So for me, I'm worried about inflation. I'm worried about rents getting too high where renters can't afford them. That's what I'm worried about. I'm worried about people not having that demand where the economy is going to implode, where there's not enough products being sold. That's my fear. And I'm okay. I just want everyone out there to worry about their personal debt. Get your personal debt load down. So when you have those payments, you don't have to go to work. You have enough saved up. You have that savings beside you, not working paycheck to paycheck, because that will liberate you. That will give you options. The quality of your life is I think incumbent upon the quality of the options you have. If you can say to yourself, I've got rent cover for the next 6 months. I don't have to go to work because of that, but I want to go to work because of that. That's a much more empowering life. If you have realtors on here that have extra money in the bank and they're saving it, put it into a deal, start investing that money and start creating wealth for yourself. That's what I want people to see right now. And I'm just afraid that, as this economy slows down and people have to go back or they're forced back to work, there may not be jobs for them to go back to work. And I think one last thing is, as you see demographics and people shifting from the blue states to the red states. Affordability in these blue states is getting to be unbearable with taxes, with regulation. And unfortunately, they're pushing up asset prices where I live in Florida and where we invest in Tennessee. And that's going to continue because people are going to continue to move. They're going to continue to look for opportunities. And that's where the growth is. If you think about back in the 1850s, it was the reverse, the migration from the south to the north. We're seeing the complete opposite now because of age, because people who are older don't like cold weather. They're moving from the north, whether you're from Illinois, New York, California, Washington, to the south. And you have to keep an eye on that. All the money, all the jobs, all the opportunities, and it's all coming down south. So be very careful where you're selecting markets. Don't look at cap rates. If a cap rate is low, don't discount the market just because of a low cap rate. Low cap rate means there's more growth in the market, there's more opportunity, and that means that residents, there's less risk. That means that residents are probably going to pay their rent in the next 5 years. Don't base things just on a lower high cap rate. Base them based on what the potential of that market looks like in the future as well.